All right, welcome back. Today, we are diving headfirst into Function 1 for the Series 7. This is all about how firms go out and get business, and, more importantly, how new securities are brought into the world. This is the very heart of the primary market, and you can bank on seeing about 9 questions from this section on your exam. It all really boils down to one big question.
How does it actually happen? A company's got this great idea, right? But they need cash to make it grow. Well, the answer is a process called underwriting, and we're going to walk through that entire journey, step by step, from a private idea to a stock you can buy, hitting every single key point you're going to face on exam day.
So here's our game plan. We'll start with who the key players are, then we'll break down how these deals get structured. After that, we'll get into the super important communication rules, the shortcuts around them, and the brand new exam traps FINRA has for 2025. And of course, we'll wrap up with a quick quiz to make sure it all sticks.
First things first, let's meet the main character in this whole story, the underwriter. You'll also hear them call it an investment banker. Honestly, the best way to think of them is like a midwife, helping to deliver a brand new security into the public market.
And that delivery happens in the primary market. This is the first time a security is ever sold to the public. It's a straight shot between the issuer, that's the company, and the investors. Now for your exam, you have to get this. The primary market is where the company raises its capital, and the underwriter is that essential go-between that makes the whole thing possible.
So how do they actually put one of these deals together? Well, it's not a solo act. It's about building a team and, this is the most important part, deciding who's going to take on the financial risk if things go south. Let's dig into how that works.
Okay, pay very close attention here. This slide is a huge deal for the exam. In a firm commitment, the underwriter is a principal. They buy all the shares from the company, period. All the risk is on them. If they can't sell the shares, too bad, it's their problem. But in a best efforts deal, they're just an agent. They sell what they can, and whatever's left over, that risk stays with the issuer. You have got to know this difference cold. Now check out this team structure. There's a really clear pecking order and a division of risk. You've got the managing underwriter at the top leading the whole thing. Then you have the syndicate members who share in that financial risk. They're also principals. But then there's the selling group. They're just agents. They help sell, but they have zero financial skin in the game. The exam absolutely loves to test you on the difference between the syndicate and the selling group.
So, how does everybody get paid? Well, this chart shows it all. The spread is just the gap between what the public pays for a share and what the company actually gets. The biggest slice of the pie, the selling concession, goes to the firm that actually finds a buyer for the share. The syndicate members get a fee for taking on risk, and the manager, of course, gets a piece for running the whole show. Okay, we know how the deal's structured, we know how people get paid. Now let's talk about the rules of the road. Because bringing a new security to market is a really tightly controlled process, especially when it comes to what you can say about it. What you can say and when you can say it is a massive part of the exam. You have to memorize this timeline. It's not optional. Before you file with the SEC, it's a total quiet period. No offers, no sales, no hyping it up. Then, after you file, the 20-day cooling-off period starts. You still can't sell anything, but you can start testing the waters and gathering interest using a preliminary prospectus. And finally, once the SEC gives the green light and says it's effective, you can start selling, and you must deliver that final prospectus. The prospectus is the official rule book for the offering. That first version, the preliminary one, is called a red herring because of this big red disclaimer on the cover. It doesn't have a price, it's just for gauging interest. But remember this rule, it's critical. A sale is never ever complete until the customer gets that final prospectus in their hands, which has all the final details, including the price. So FINRA basically puts all communications into 3 buckets. The one you really need to watch is retail communication. If you send something out to more than 25 retail investors in a 30-day window, a principal has to approve it before it goes out. That number, 25, is a classic test question. And hey, while we're talking about FINRA, don't forget the muni world. MSRB Rule G-21 has very similar rules about advertising for municipal bonds. It has to be truthful, not misleading, and also needs principal approval. And speaking of numbers to memorize, here's another big one. For a brand new IPO that's going to be listed on an exchange like the NYSE or NASDAQ, dealers have to keep giving a prospectus to anyone who buys the stock for the first 25 days after it starts trading. The whole point is to make sure that even people buying in the secondary market right away are getting the full story. Now, be careful on the exam. That period can be 40 days for a secondary offering or even 90 days for an IPO that trades over the counter, so read the question carefully.
Let's be honest, going through a full-blown SEC registration is a long, painful, and expensive process. So, of course, there are some shortcuts. And you better believe the exam expects you to know these exempt transactions that let companies raise money without all that hassle.
This slide right here, this is pure gold for your studies. Reg D is for private placements, usually to wealthy or accredited investors. Reg A Plus is kind of like a mini IPO. It lets smaller companies raise money from the general public but with way less paperwork. And Rule 147, that's a strictly local deal, only for residents of one single state. Know the key differences for each one.
So what does it even mean to be an accredited investor? Well, here's the definition you just have to burn into your brain. The SEC says you're sophisticated if you have either a net worth over $1 million, and no, you can't count your house, or you've had a high income for the past 2 years. This definition is the key that unlocks the door to most of those Reg D private placements. All right, let's talk about what's new and what's coming. The Series 7 isn't a static test. It's always being updated. Knowing what FINRA is focused on right now for 2025 can give you a serious advantage by helping you guess what kind of new questions might pop up. And to see why they're so focused on this, just look at this quote straight from FINRA's 2025 report. They are seriously worried about new tech like AI being used to commit fraud and manipulate the market. This isn't just theory, it's a real threat that's shaping the new rules you're about to see on your exam.
So here's what that means for you on test day. 3 big things. First, any marketing about crypto has to be kept totally separate from traditional stocks and bonds, and it needs huge disclaimers about risk. Second, if a firm uses AI to write an ad, it's treated exactly the same as if a person wrote it. All the same supervision rules apply. And finally, firms are on the hook for their vendors. You can't just hire another company to do something and then wash your hands of the compliance responsibility.
Okay, that was a ton of information. So let's lock it in. It's time to test yourself with a few practice questions that look a lot like what you're going to see on the real thing.
Question 1. An underwriter is acting as an agent, and they have no financial risk for any unsold shares. What kind of commitment is that? Take a second. If you said best efforts, you're absolutely right. The risk stays with the company.
Next one. During that cooling off period, what's the one and only document a rep can use to see if people are interested? That's got to be the preliminary prospectus, also known as the red herring.
And for our last question, a Reg D private placement can be sold to all the accredited investors you can find, but what's the maximum number of non-accredited investors allowed? That magic number is 35. And that's a wrap on Function 1. You know, if you really step back and look at it, every single rule we just covered, from how a syndicate works to when you deliver a prospectus, it's all designed to do one thing: ensure full and fair disclosure for investors. If you can get that core idea and you master the timelines, you are going to be in fantastic shape for this section. The real question is, as tech keeps changing, how will the rules change to keep protecting that principle? Something to think about. Good luck with your studies.